If you've spent any time at all watching crypto, you've seen it, right? Bitcoin, or really any coin, just suddenly nosedives. We're talking 10, 20, sometimes 30% in a single day. It feels totally chaotic, completely random. But what if I told you that these violent crashes aren't random at all? What if they're actually a predictable, even necessary part of how this market works? Well, let's break down exactly how that happens. You know, the source material for this explainer puts it perfectly. This flush is always just waiting in the wings. It's not some kind of bug or a market malfunction. No, it's a built-in feature of the system. And honestly, understanding this one mechanic is pretty much the key to navigating these incredibly volatile markets.
So, what exactly are we talking about here? A liquidity flush, you might also hear it called a leverage purge or a stop run, is a structural, almost predictable event in crypto. The best way to think about it is like the market's own self-cleaning mechanism. It's designed to wipe out all the excessive risk and leverage that's built up. Yeah, it's a painful process for a lot of people, but it's a necessary one.
To really get why this is a mechanical necessity, we need to look at the anatomy of the purge itself. It's not just one thing, it's this powerful three-step chain reaction, a cascade that once it starts is very hard to stop.
Okay, so step one, you get what's called a crowded trade. This is when pretty much everyone is on the same side of the boat, all betting the price is going to go the same way. Then step two, a small price move against them triggers forced selling. These aren't emotional people panic selling, these are automated, pre-programmed liquidations from the exchanges. And that's what leads to the third and most dramatic step, the liquidity gap.
And this is where things get really wild. The liquidity gap. See, during these moments of extreme volatility, the big market makers, the ones providing all the buy and sell orders, they pull their orders to avoid risk. They just vanish. So you suddenly have this flood of forced selling hitting the market, but there's nobody there to buy. The order book is incredibly thin, so the price doesn't just drop, it effectively teleports down, instantly crashing to the next price level where a big cluster of buy orders is finally waiting. That's why these crashes are so incredibly sharp and sudden.
All right, so theory is one thing, but let's see how this plays out in the real world. I mean, the recent cycle from 2025 into 2026 is just a perfect textbook case study of these mechanics playing out on a massive historic scale.
Let's set the scene. It's October 2025. Bitcoin has just screamed past an all-time high of around $126,000. The euphoria it's just off the charts. Everyone and their grandmother's convinced we're going higher. This right here is the absolute definition of a crowded long trade.
And, well, here's how it all played out. Right after that peak in October, we got the first incredibly violent flush in December. That was followed by this long, grinding period of deleveraging that lasted all the way through February. And that brings us to today, March 2026, where we're in what feels like a transition phase.
Now let's put some numbers on this because they're pretty staggering. At the peak, you had total euphoria. Then the initial flush hit, wiping out over $2 billion in leveraged positions in a single day. The deleveraging that followed gave us 5 straight months of negative returns. It absolutely crushed morale. And now the market's trying to find its footing around 70K. But here's the crucial point. That massive amount of long leverage, it has been completely purged from the system, wiped clean.
But here's where the story takes a really fascinating twist. After months and months of just washing out the bulls, the entire market has completely flipped on its head. We've seen what you could call a great role reversal. And the change is just dramatic. In late 2025, the market was so heavily skewed long, with everyone betting on higher and higher prices. Fast forward to March 2026, and the situation has completely inverted. The market is now crowded on the short side, with most traders betting the price is going to fall even further.
And the data, man, the data totally confirms this. Just look at the open interest. That's basically the total value of all the open bets on the future price. It peaked at a whopping $47 billion back in October. Today, it's down to just $21 billion. That massive drop, more than half, represents all that bullish leverage that has been flushed right out of the system.
Here's another key indicator. It's something called funding rates. Right now, they're negative. Now, what that means in simple terms is that there are so many people shorting the market that they are literally paying a fee to the people who are holding long positions. Think about that. It's a crystal clear sign that being bearish, betting on lower prices, is now the crowded trade.
So, let's connect the dots. If a flush happens when a trade gets too crowded,
and we now know that the short trade is the crowded one, what happens next? Well, the exact same mechanical principle applies, just in reverse. The next potential flush isn't down, it's up. It's what we call a short squeeze.
And we can even see the new targets on the map. There are these huge clusters of short liquidation orders sitting right above the current price. A move above $72,000 could be enough to trigger that chain reaction. And if the price breaks through $75,000, it could liquidate over $180 million in shorts, potentially teleporting the price higher, just like we saw on the way down. The path of maximum pain for the market is now to the upside.
Okay, so let's just zoom out for a second and think about the big picture here. We've seen how the market builds up this massive leverage, how it violently flushes it out, and then how it completely reverses sentiment. This isn't just some one-time event. It's a timeless principle of how market cycles work.
And this really brings us to the most important takeaway from our source material. Historically, it's these quiet periods after a big flush, when the market is resetting, when fear is high and everyday interest is low. This is precisely when sophisticated long-term investors, the so-called smart money, begin to quietly build their positions for the next cycle.
So we end up right back where we started, but with a new perspective. The cycle has played out just like the mechanics said it would. The extreme bullish leverage is gone. It's been flushed. And now the bearish leverage is crowded. So knowing how these liquidity flushes work, what do you think is the most likely next move for the market? Thanks for tuning in.